Good morning and welcome back to Almus Market Mornings. Fresh numbers out of Washington show first quarter GDP slipped into mild contraction and consumer spending slowed more than the economists had penciled in. Traders responded right away. The markets now assign roughly a 3 in 4 chance of a 25 basis point cut in September and even a 1 in 5 shot at a larger move. On the trade front, the US and China reportedly finalized a rare earth supply deal, an effort to smooth tariff frictions and secure critical materials for the American industry. Good morning, JK. How are you reading the host of US data which was released yesterday? Does it change any of your outlook?
Good morning, Swaraj. So yesterday was, quite a few landmarks were seen yesterday. Dollar index hit 3-year low, below, just about 97. And we also saw the Nasdaq and S&P 500 reach their all-time highs once again. And this is a remarkable comeback from the steep fall that we had seen. Nasdaq had fallen almost 30% after the reciprocal tariff issue came up for the markets. And also, the trade war with China got intensified with a lot of export controls and all that. So now this definitely very remarkable. And not only that, most of the markets now, even Japan is picking up. Indian markets are also not very far from their all-time high. So we are once again into that euphoric phase. Uh, that's a big development for the markets. And apart from that, the data itself was not a matter of concern for the markets because if you look at the GDP number, it's actually a backward-looking data, and most of it is also already known to the market because we get the monthly cyclical data on all these things, and now GDP is only compilation of all the data put together and how it turned out into aggregate activity level. So if you break down the data, consumer spending definitely was disappointing at 0.5% versus 1.2% previous month. So that's disappointing, and it has a big impact on the GDP because that happens to be 60 more than 65% of the GDP compilation. Then we had the government spending also that came. What was impressive was good increase in the uh, the fixed investment, and that which means that businesses are not so pessimistic as has been thought of. I think markets took these points quite positively. Some of the negatives were well known, so not really of a concern to the market. But on the good news, durable goods orders rose massively to 16.4% from minus 6.6% last month and 8.5% that was expected. Even ex transport, it was higher at 0.5%. Even if you think that most of the orders were for the vehicles and the airplanes, it was still a good increase. Then jobless claims were lower than expected. 246,000 was expected, and it came at 236,000. Although it remains at slightly elevated level. Only concern was the continued claims, which actually is an indicator of how easy or hard it has been for people out of jobs to find a new one. That rose to 1.974 million from 1.937 million. So all in all, I think the data did not really impact the markets. As I said, stock markets new high. Even the yields hit fresh lows for the cycle. 10-year hit 4.25%, and not long ago, people were visualizing even 5% for 10-year. So now, of course, the yields are not moving just because of the data. It's also because of the major factor of what the Fed is likely to do. As you said, September, there are 95% probability of a rate cut, and some are even starting to expect a 0.5% rate cut in September. Of course, July will be a no change meeting. And of course, by end of the year, now expectations are slowly rising towards three rate cuts, and these are the reasons why the stock markets have also improved, and even the bond markets have rallied. Added to this, the budget bill, which is going through the Senate right now, is proposing a lot of tax cuts and spending proposals. All this again is likely to give a boost to the GDP. So if you look at the forward-looking GDP number, it should probably be a much better number than what we see for Q1, and that reason the markets have taken it quite positively. Now, of course, for the dollar, as I said, it was a landmark, I would say, because in a very short period of time, it has fallen, about 10% against the major currencies, and a three-year low was hit. And if you look at, the past data, you see that, it is one of the worst 6 month performance for the dollar index since 1991, and it's the first half since first half performance since the start of floating exchange rate about 52 years ago. So some sort of a landmark. Yes, the dollar's down move has been backed by very strong negatives. Major of them being the worries about U.S. policies, the structural deficits about which market is getting more and more concerned, and also the need for de-dollarization that the central banks and even the investors have been feeling. And the latest trend has been that people who have invested large amounts in the US have started to hedge themselves against the currency risk. These are good reasons for why dollar have been sold, and the move doesn't look like over. Although one gets a feeling that almost as we enter the summer period, there could be some sort of a consolidation, for the dollar, that's likely, maybe a few points lower, and then we can see a profit taking move in the dollar, maybe towards 99 or even 100 by the time the summer is over, because we also need a trigger for such a move, and that may be likely in the tariff negotiation outcome that will be known by July 9th. So I think now we sit on hands and see where the dollar goes from here. So on the rupee also, yesterday we made a strong down move towards 85.62. Again, backed by quite a few positives, like the continued downdraft in the oil price, the geopolitical tensions easing, good inflows for IPOs. And in fact, the secondary market also saw a large inflow from FIIs yesterday. And the dollar index, of course, hitting the three-year lows. So it was not a surprise that dollar rupee fell a few notches lower. But the actually gains have been quite limited because of a few factors, like Chinese yuan has not been moving, and we track the Chinese yuan move quite closely, and also some nationalized banks continue to absorb some of the flows at intermittent levels, and of course we are also nearing some sort of a psychological point at 85.50, from where we have seen good bounce in the recent past. So market is not very enthused to sell too much at these levels. At the same time, something to cheer for the exporters, because the premiums have gone up with the US yields falling, and the liquidity tightness somewhat expected in the local market after RBI announced a uh, large reverse repo of 1 lakh crores. So this has led to the differentials between India and US widening, and so premiums inching up from 1 rupee 52 paisa to 1 rupee 71 paisa. About 15 basis points rise is what we have seen. And so that's something to cheer, although the spot is not very attractive for the exporters. They would rather wait for better levels to sell at these premium levels. All in all, we now look forward to the PCE inflation number, which is the most important number that we look out for from the Fed's point of view, and with pressure mounting from the political side for early rate cuts. Trump even contemplating naming the new successor to Powell, although his office ends only in 2026. If the number comes weaker, the pressure will be even more, and that is what we look forward to in today's number. A lot to look forward to from today's number from the policy point of view and for the dollar as well. Thank you.
Thank you, JK. And as you mentioned, quite a few landmarks. We are back in the euphoric phase for markets, and I think generally investors are in a good, positive mood given how the summer is going. Dollar index hit three-year lows. Nasdaq and S&P 500 hit all-time highs. And as JK mentioned, even for Indian indices, we are inching up to those all-time high levels. For Rupee, we saw a strong recovery towards 85.62. Good inflows for the IPOs as well as secondary market FII flows have been quite strong. That has resulted in this recovery in the Rupee. Premiums have widened more recently a notch, but spot isn't as attractive for the exporters as it was a week back. The key data today to look out for would be the PCE, which is a very important inflation metric from the Fed's point of view. And a fall in PCE would put further pressure on Fed to go ahead with the rate cut. That's it from us today. Thanks for listening. Tune in tomorrow. Sorry, tune in on Monday with the fresh round of updates from us. Thanks for listening.